What's up, guys? Dom here from Refinance. Now, today I wanted to go through effectively a way that we can make you $4,000. It's a little pocket where you can do it now, but you won't be able to do it in the next few months, and I'll explain why. So, the big news in the refinancing and home loan world is that cashbacks are looking to be on the decline. We've had most of the majors, a lot of the other guys competing for the top four spots, like the INGs, the Suncorps, they've all stopped on the cashbacks. The reason why is a little bit hard to determine, but my opinion on the matter is probably that the banks all they raced to be like, although rates are higher, their margins probably aren't as big as they were a few years back, because obviously they have the Reserve Bank rate they have to buy the money at. But the margin after that has actually reduced by about 10, 20 basis points. So while they've all been racing to be the cheapest, it's maybe affected the bottom line. And when we combine that with the nature of higher rates, potentially meaning higher default rates, it's meant that the banks are looking to become more about, before it was all about volume, making larger, well, smaller money on just larger quantity of deals going through. Now it's kind of the opposite, where they might be happy to take a little bit less volume, but just to have a fatter margin. Now, ultimately, that's not good for the consumer because you'd rather them be looking at it from a volume perspective, meaning they're making less money on your home loan. But and this is of course just my opinion because you're never really going to get an answer from these guys, but I'd be pretty confident this is a major pulling point. The other thing that's been happening is some people are taking advantage of these offers in the past. Ideally you'd get to one of these banks, you'd stay for 2 years, and you could rinse and repeat. And everyone wins in that scenario. There are some that have been doing it a little more frequently than that, and ultimately it's something that the banks want to stop because they're not making money. And in fact, it probably even has that trend on your credit report too. So all of those factors combined just means the banks are pulling back on cashbacks. And I guess mortgage brokers like myself, it's been crazy because the general reaction to this from mortgage brokers has been fantastic. Yeah, we're happy. Because what it meant before was just you're doing more work for the same client. And so mortgage brokers are happy because it's kind of, they might have clients that just stay for longer periods with loans, and that's fine. Myself and really any mortgage broker that looks at things from a we want to save our client the maximum amount of money point of view, it should be unhappy about this news because it's just less money to you, because cashbacks are a great tool for you to make an extra 3, 4, even $5,000 on your mortgage. So we're actually, upset at this trend. It might be something that comes back around in a few years when rates are lower. But for now, it's something that you should be, unhappy about because, it's been a tool to make you more money. And if you've used it, great. And, you know, there's a lot of different perceptions from, we get people commenting all the time, oh, they'll give you money, but they'll take it from you somewhere else. No, it's not that. They're just giving you money. If you're smart about it, you can take the money and it's just another 4 grand on top. So this video is going to go through how you need to look at this moment right now, what you need to do, and effectively you can make 4 grand now when you can't make that in a few months. And 4 grand for most people is a lot of money. That's a holiday, that's tuition, that's, massive. So let's go over some material data and I will help you interpret this. And yeah, hopefully you guys agree and hopefully it prompts you to want to do something. So first, let's talk about why cashback is a broken way to save money. It always has been, it always will be. In my opinion, it's just completely nuts that the banks were even doing this. So, let's understand the first concept. This is more of a variable marketplace. So when rates were low at 1.89%, it was a fixed marketplace. Rates were low, you wanted to fix. Now rates are higher. So ideally you don't want to get caught fixing if rates move south. So rate, of course, is important, but for example, you might refinance to a variable loan now and you might fix in 12 months. So how important was that variable rate? Still important, but is it, as important as it was when you're fixing. It's not. So let's look at how a cashback contributes to savings. You know, if you had a 250K loan, which is obviously quite a small loan, and you save 30 basis points on that loans for a refinance, that's about 750 a year or 1,500 in 2 years. I like to encourage my clients to look at it from 2 years. If you look at it from 30 years, too many things will change. If you look at it from 6 months, it's not long enough. So over the 2 year period, you're saving $1,500, which is still worthy of doing the process, but you're also getting $4,000. So total value is about 5,500. And you can see the cashback it's the major part of the savings. Like you can't 1,500 versus four grand. Like that's, how can you not think that is a massive way to save money? Now, if you had a slightly larger loan of 500K, over 2 years, you're still saving 3,000 in interest and the cashback's 4 grand. Now we're about on parity, but you can see the total savings of that 7 grand. It's just massive. Like that's 7 grand in your pocket over 2 years that, that just wouldn't be. Like there's no, it's not like that comes, it's not like there's an opportunity cost. It's just here's 7 more grand of your hard earned money that is now back in your bank account. And of course, if you had a larger loan, the savings just get bigger. Now we're at a point where the interest trumps cashback, but still, what the combined value of the savings is just massive, massive money there. And of course, this is point three. This is conservative. We see guys who are 50 basis points, 75 basis points out of the market. So, you got to owe it to, like, the bank is not going to give you the best rate. They want to make the most money from you as possible. They want to find a nice spot where they're making good money from you, but it's not, it's not that bad that you're just going to blow up. And for different people, it's a different number. So yeah, just health checks always worthwhile. Even if you don't do anything, just find out if you want a decent deal. So let's get to the cashback news. So who's stopping? CBA and Bank West have stopped. These guys were never really massive on the cashbacks anyway. They were generally $2,000 or $3,000. Not really, this isn't really what they were doing. So it's probably easy for them to pull out. NAB, same deal. They were never, well, they previously were, but lately they haven't been massive on the cashbacks. Ubank was a big hit. They were a major player with the cashbacks. They've obviously stopped. The big news was the Westpac stopping. They have been a massive one. So the good news is there's still about a month or so before they're completely stopping. So, I'll get to that later, but that's still one to watch. And ING and Suncorp have stopped or are stopping. Two, considerable lenders that were providing value in this space. So who hasn't stopped yet? And these are guys that we really need to keep our eyes on. Now, St. George haven't stopped yet. Westpac have. So, the writing may be on the wall that these guys will announce it soon. In fact, probably when you're watching this video, they may have stopped anyway. ANZ have not given a signal that they're going to stop, but if everyone else stops, why would ANZ just be giving you 4 grand and no one else will? You know what I mean? It's like they might give you something, but there's no way the best deal needs to be $4,000 better than the second best deal. And MeBank are still going as well. Similar to ANZ, no real, we haven't heard any signals that they're going to stop. But we really need to expect they probably will stop at some point. It's kind of like a term that we use around petrol stations, right? It's like an oligopoly. So if you had, let's say, an intersection where you've got 4 petrol stations, you've got a Shell, a BP, Mobil and Amp or whatever it's called. I'm not a petrol station guy, but you get the point. So let's say really 3 of the petrol stations are all at $1.50. Well, actually, let's say they're at $2. Petrol's not cheap anymore. And you've got one petrol station at $1.50. So you've got one petrol station 50 cents cheaper on the same intersection. Are they going to stay $1.50? Even if they want to be the cheapest, really they can be $1.80 and still get all the business. Why would they be $1.50? This is kind of what's happening with these guys at the moment. Even if they don't stop, they don't need to be $4,000 better than the next guy. They might be $2,000 or $1,000. Who knows? But you have to just look at that from just a common sense point of view. Like no one, the banks they want to give you the least amount of money to still make the deal. So yeah, let's consider that. Now, pretty much who needs to make a move now? There's probably three categories of people. Two of those categories should be doing something now. Now, first, I'm going to start with the person who shouldn't be doing something. Um, if you're fixed for longer than 6 months, you shouldn't be doing something. You're chilling. You're on a low fixed rate, or hopefully you are. You don't need to do anything. Just see out your fixed term. Um, ideally you've got another 2 or 3 years left, but that's probably unlikely. Chill, you're on your fixed term, see it out, worry about this 6 months before it expires. So that's the person that doesn't do anything. Now, these are the two people that you should be doing something. First, obviously, you're on a variable rate. Um, if your loan's just fluid, you're on a variable rate. Ideally, we put an application in before these lodgement dates of Westpac or some of these guys end. Get your deal in very soon. The month of June, this is the hot, like no one's going to be saying this in the news or anything, but in my opinion, the month of June 2023 is the hottest time to refinance because June saves you $4,000 more than July. So like it's no one will say that, but that's the reality. You lodge in June versus you lodge in July, you get another 4 grand. None of this is absolute, but as we've just discussed, the writing is kind of on the wall with that assumption. So variable, simple, lodgement now, settle when we settle, perfect. Now, the third type of person is someone that's on a fixed rate, but it's going to be ending shortly. Let's say within the next 4 or 5 months or 4 months. Because the reality is, in 4 months, you may not have a cashback deal, but now you do. What we can actually do is we can stagger an application. We can do the work now, lodge something in the month of June, and essentially we just have the application. We can get it approved, but it can just sit there for a few months until your fixed term finishes. If you're fixing if you're expiring on the 1st of September, great. We lodge in June, we settle the 2nd of September. If your fixed loan expires at the end of October, great. Let's lodge now. Let's settle the 1st of November. For us, like as brokers, we don't get paid it's a few months after your loan settles. So this isn't like we're saying this isn't some elaborate plan where there's a massive benefit for us. It's just simply we can lodge you a deal now that we know you won't be in a couple of months. So it's a great win in my opinion. So yeah, in summary, if you're fixed for long term, just chill, don't do anything. If you're variable, massively do something now. If your fixed rate ends shortly within 4 months, again, do something now. This all makes a lot of sense for you. And lastly, is just some general knowledge on how you need to look at this cycle at the moment. And this is massive, massive kind of asterisk here. This is not financial advice. This is just my opinion. This is just conveying some of the data I've seen. Credible data, not news, like not the 6 o'clock news where they're getting stressed out and everything like this is just like what economists are saying, what data is showing, and ultimately what I'm seeing by just speaking to 30, 40 people every day about home loans, what my 25 staff are seeing. I think we've got our finger on the pulse, and this is this is some advice on a train of thought that you can adopt. So, as I kind of briefly touched on, you're getting into a new lender with a variable rate now, most likely, given that rates are higher. You probably fix with this same lender within 6 to 18 months. I'll give you an example. Let's say you refinance at 5.3 on a variable rate right now because you don't want to fix at 5.5. Then within 9 months, all of a sudden, some external change happens and we've got access to fixed rates at 4.2. We'll be giving you a call saying, rates at 4.2 could be a good time to fix given your variables 50 basis points higher. So that's why the cashback it's a major trump card given that the rate you're going on to right now, you could volunteer, you could change that shortly anyway. The other part to look at is equity from your home. So a lot of people are in positions where they're struggling for repayments. They don't have cash reserves, and they're stressing because they're paying, a lot more than they were a couple of months ago. So ultimately, what you can do is when you refinance, if your loan's 400,000, you can actually refinance it to 420, meaning you've got 20,000 extra. Now, what you do with this 20,000 is you put it against the loan, and it works like a credit card. So you've got $20,000 if you need it, and you only pay interest on it when you need it. So why is this great? Well, if your repayments are struggling, you've got 20 grand there. You don't have to miss a repayment, because if you miss a repayment, your credit score gets hit. And once your credit score gets hit, the banks increase your rate because you're higher risk and you're less likely to move. So, if you're even in a position where you could miss a repayment or there's a bit of stress, just do this. Like, it doesn't cost you anything. Just get 20, 30 grand from your home and have a backup, because it's better than getting personal loan, missing a repayment, or, defaulting, or even losing your house. I don't know. That's probably, a crazy thought, but well, why even have that into your mind if you don't need to? Now, the other way you need to be looking about your wealth and your home is your wealth is about your equity position and not how many loan years are left or even your loan total. Commonly, I'll speak to a client and they'll say something to me like, oh, I don't want to refinance for longer years. And I always encourage clients not to look at it like that, because you could have a 30-year mortgage, but you could still pay it off in 5 years or 10 years, or, you can make extra payments. When you go 30 years, what you do is you say, I want the minimum amount of repayments, and it's up to me if I want to pay more. It's not up to you, it's up to me. And that's great, because if there's a major event like a loss of a job, schooling, a holiday, you're not in a position where you're forced to pay more than you have to, because once you're on a 25-year loan term and you want to reduce that, the banks don't just make that change. And so that's why it's important not to really think of your loan like, oh yeah, I've got 25 years left. Like that's not the way. Think of it like, I've got a loan of 300, my house is worth $1 million, I've got $700,000 of equity. That is the true value of your home. You can have a perception of, I've got 300 grand left on my loan. That's great. But just try to get out of the habit of thinking of it like, oh, I've got 25 years left. Because it's not, you're not, like, you don't have to pay it off in 25 years. But what you do know is you have a loan of 300 and you have equity of X. And once you start thinking about your loan like that, making a decision like getting 10 or 30 grand extra of equity, to not stress, it's more palatable, because you might have, your home, you might understand that, okay, in the last 3 years, I've made $400,000 of equity in my home. Things are getting tight. I'm stressing out a bit. So I might just get that 10 to 30 grand extra, because what this does, it keeps me in this house. And I want to be in this house when interest rates drop again in a couple of years to 2%, because guess what? I want to make another 2, 3, 400 grand on my home. But if you're forced to sell now because you know, you're not thinking about tomorrow, that's what could happen. So that's kind of my closing thoughts, and just how I'd encourage everyone to look at their mortgage. Again, cashbacks, completely broken way to save money. They always have been, they always will be. It's just banks giving you money for switching. Like, how is that not broken? And they're going to be stopping it soon, based on what we're hearing. So the month of June, potentially the hottest time to refinance ever, given that what's here today in June may not be here in July. So make sure to click the link below or in the description to start an application, or just get a health check. We can make all of this happen for you, and one of my brokers will be happy to have a chat. They'll go through everything. They'll help you understand the best deals, and make sure you like, comment, subscribe, and just really have a bit of a think about this, guys, because we want you to save the most money. So hopefully speak to you soon. Bye.